What's up, everybody? This is Lee from Adaptable Wealth, and over the next few months, we're going to be diving into the world of alternative investments to help you understand all your options for protecting your monetary wealth over what is setting up to be a very challenging decade ahead. Savers and investors face extraordinary challenges. Inflation is eating more than 10% of your savings, and most assets are overvalued at a time when the Federal Reserve is raising interest rates and sucking liquidity out of the market. So far, this has meant a beating for stocks and bonds, and it looks like crypto is about to fall off a cliff as well. There's also the looming threat of a world war, and we're well on our way to a cashless society centered around central bank digital currencies and crypto. Extraordinary challenges require extraordinary solutions. So in this video, we're going to explore the world of alternative investments. This video is an overview of the space with a focus on the risks and returns of alternative assets in general. In future videos, we'll be deep diving into each of the 7 segments of alternative assets. And by the end of the series, you will understand the nuances of each market, the risks and potential returns, as well as how to analyze an investment and where you can go should you decide to invest in any of these assets. It's important that I clarify what I mean when I say alternative investment, because there are dozens of definitions out there. When I refer to an alternative investment, I'm talking about any asset that is not a public stock, bond, fiat currency, or a strategy using any of those. More specifically, I split the space into the following 7 segments: precious materials, collectibles, commodities, land, cryptocurrencies, businesses and lending, and environmental. Now, when you're considering investing in anything, it's very important that you thoroughly understand the benefits you could reap, the risks or the things that will cause you to lose money or come out thinking it was a poor investment, and finally, what percentage of your net worth you'd like to allocate to this investment. Until recently, the price tag and government regulations, like having to be an accredited investor, have kept many alternative investments out of the reach of ordinary investors. Now, technology and deregulation are opening the space to ordinary Joes like you and me. You can now buy fractional shares of art, real estate, farmland, cryptocurrencies, and more, and it's all made possible through crowdfunding and other shared ownership schemes. Other reasons investors commonly give for investing in alternative assets include low interest rates and overvalued traditional assets. The search for higher yields and cheaper assets has pushed investors to look for alternatives to stocks, bonds, and other traditional assets. Inflation. Investors tend to flock towards real assets during periods of high inflation. The potential for higher returns. You have a better chance of generating the types of returns you see for rare whiskey and cars if you deeply understand the market you're investing in. If you're just throwing money into alternative investments because it's the latest fad, your returns can be drastically lower. In that case, just stick with traditional investments. Yield or cash flow. Investments into real estate, timberland, farmland, cryptocurrencies, and businesses can pay dividends, interest, or a share in the sale of the produce from the asset. In my opinion, you should invest the largest portion of your monetary wealth in income-generating assets, whether they be traditional investments or alternative investments. Tax-saving opportunities. Let me preface this by stating I am not a tax professional, and you should consult your tax advisor for most, if not all, of your tax strategies. Having said that, I see 2 opportunities here. First, the opportunity to offset your taxable income. It's well known that you can generate tax deductions by donating assets, and then you can use those deductions to offset taxable income. The appeal of using alternative investments in this case is the fact that they are inherently more difficult to value. This creates the opportunity to inflate the value of the assets that you donated so you can take a larger tax deduction. This is not possible with publicly traded stock because the value is easily verified. But if you can donate a $500 painting and get that painting appraised for $5,000, then you keep the difference. The second tax opportunity is the passing of untraceable assets to your heirs tax-free. Investments in things like coin collections, precious materials, cryptocurrencies, wine, watches, etc. can be held anonymously and therefore transferred to your heirs without anybody knowing. The recipients won't have to pay taxes on it. Yes, it's technically illegal, but people do it every single day. Again, this is not advice in any way, shape, or form. It is solely for informational purposes. The sixth reason investors commonly give for investing in alternative assets is diversification. Diversification is simply the spreading of your money across multiple assets with the goal of reducing the correlation between the assets in the portfolio. This reduction in correlation has two main benefits. First, it's going to reduce the total volatility of the portfolio. And second, it will reduce the impact of a decline that any one or a few assets has on the portfolio. The theory is that the gains will be lower, but the drawdowns will be smaller as well. In other words, it's possible to reduce the probable outcomes of your portfolio without materially decreasing your expected return. For example, take a portfolio with 4 equally weighted investments. If one of those investments decreases by 40%, your whole portfolio goes down by 10%. Compare that to another portfolio with 10 equally weighted investments. If one of those investments drops by 40%, your whole portfolio only goes down by 4%. Diversification can reduce the impact of large declines on your portfolio, but it is also going to diminish the benefits of large gains. Another factor of diversification that's often overlooked by investors is the ability to hold assets outside of the traditional financial system. Items like cryptocurrencies, watches, art, precious materials can all be self-custodied. Now, this usually means lower liquidity and higher carrying costs, but there is one exception, and that's crypto. Unfortunately, greater adoption and regulation is going to pull crypto farther and farther into the traditional financial system. Now, let's look at some risks of alternative investments. First, you must understand that there's no such thing as a risk-free investment, and anyone who tells you otherwise doesn't know what they're talking about. U.S. dollars and treasuries are considered the least risky holdings in the entire world, and both of them come with risk. Inflation can eat away at your purchasing power, higher interest rates reduce the value of both due to foregone opportunities, and although the default risk is low, it's not zero. Given these facts, you'd be a fool to dismiss the alternative investment space as too risky. Instead, you should understand the risks, compare them to the expected returns, and try to find ways to manage and mitigate those risks. The first risk you'll face as an alternative investor is poor due diligence. I put this first because you directly control this variable. Most people don't fully understand the markets they're investing in. They just throw money into it and hope for the best. That's a bad idea in any market, but especially so in the world of alternative investing. The second risk you'll face is little to no transparency. The lack of transparency and regulation in many of these markets creates several problems for investors. The scams pulled by well-connected, wealthy investors in the art market is no secret. It's easy to pull a scam when accurate valuations are hard to come by and the market makers have an incentive to inflate the price of the assets that they help sell. This doesn't mean you shouldn't invest in alternatives. Just be aware that there are scams out there, so be cautious. Counterfeiting. Less transparency naturally invites counterfeiting. Deal only with reputable companies and get a certificate of authenticity whenever possible. If not possible, have an independent third party confirm its authenticity. Accurately assessing the value of an investment. Many investors would argue that the value of an asset is determined when it is sold. This is not necessarily true. The problem is that many of these alternative investments are not traded often. As a result, we lack robust order flow, price tracking, and reporting, which can make it difficult to gauge the dispersion of bids within these markets. Because of this, accurately determining the value of some of these assets can be quite difficult. The third risk you face is poor liquidity. Many of these alternative investments are physical things like collectibles, precious materials, and land. They take more time and effort to sell if desired. In fact, many investments into private equity, hedge funds, and shared assets are subject to what's called lockup periods. In some cases, you are prohibited from selling your shares at all before the lockup period ends. In others, you'll have to pay a fee to get out of your investment before the lockup period. Lockup periods can last up to 10 years, as is the case for some private equity investments. Now, you can increase your liquidity by investing in the paper form of some of these alternative investment vehicles. Unfortunately, the increase in liquidity is minuscule compared to a stock or ETF. These fractional shares don't trade on major exchanges. Instead, they only trade on the platform in which you bought them. This significantly limits the number of buyers available to purchase your shares at any point in time should you decide to sell. Not to mention, holding paper assets defeats the purpose of investing in alternative assets for some people. The fourth risk you face is the fact that diversification may be a mirage. Investing in alternative investments can absolutely diversify your portfolio. However, as I pointed out earlier in this video, we lack robust order flow data, price tracking, and reporting for many of these alternative investments. This can create the illusion of low volatility and correlation when compared to highly liquid assets such as stock. For example, if a collectible watch sells every 2 years and the price is 10% higher each time, there will appear to be very little volatility. Compare that to the daily ups and downs of a stock. Not only will the watch appear to be less volatile, but the correlation to stocks will be low as well. But if you use only 2-year observation of stock prices, just like you did for the watch, it may be that the two are much more correlated than you thought. Those who don't understand these types of dynamics will think that they're holding non-correlated assets because the numbers say so. In reality, that may not be true. Not only is it easy to be fooled into thinking you're holding non-correlated assets when you may not be, most shared ownership schemes are nothing more than fiat-denominated paper assets. The insane price tag of some alternative investments requires that most people buy shares of the underlying asset. These shares can be registered with the SEC and are only tradable on the platforms from which you bought them. In other words, you're back to holding paper assets denominated in a fiat currency, most likely dollars. I don't know about you, but I have plenty of exposure to dollar-denominated paper assets. I'm looking to spread my monetary wealth outside of the fiat currency paper asset system. If one of your goals is to hold assets outside of the traditional financial system, you'll need to avoid paper assets. Own the underlying asset instead and self-custody it. So we've reviewed the benefits and risks of alternative investments. The final consideration is how much you want to allocate to this space. This is a difficult question to answer because it's highly personalized. Just like any investment decision, asset allocation depends on the risk-reward trade-off of each individual investment, your required rate of return to meet your personal financial goals, your current financial situation, and your risk appetite, which includes not only your willingness to take risk, but your ability to absorb losses as well. If you're a multi-millionaire and are comfortable taking risk, then there's no reason you can't go up to 50% or more as long as you know what you're doing or you have an advisor who does. According to a KKR study of high net worth money managers, the average allocation to alternative investments, as I define it, was 50% as of the end of 2020. On the other hand, if you're middle-aged with about a $500,000 net worth, you may want to look at something in the 5 to 20% range. And if you're just starting out, I would ignore the alternative asset space altogether with the exception of real estate and Bitcoin. Again, it depends on your experience, knowledge, risk appetite, and the required return to meet your personal financial goals. Having said that, the purpose of investing in a specific asset class is to take advantage of the risk-reward trade-off that the asset class offers. Allocating too little, like 2 or 3%, is not going to make enough of an impact to matter. Because of this, I like the 10 to 20% range. Now that we have a foundation for considering alternative investments, I hope you'll join me over the next few months as we deep dive into each of these 7 alternative asset classes. But before we wrap up this intro to alternative investments, here are the 5 bonus investments I promised you. These 5 investments all fall under one umbrella, and that is invest in yourself. There honestly isn't a better investment than you. Not only can it help build your monetary wealth, it can help improve your life holistically. The first investment is build your skills. Not only will you improve your earnings capability throughout your career, it'll help protect you from a job loss, and if you are laid off, it's more likely that you bounce back quickly. It also opens up tons of opportunities outside of your 9 to 5, such as our second bonus investment, starting a business or side hustle. In addition to the freedom it can create for you, it takes the standard process of earn, pay taxes, and then spend, and flips it on its head to earn, spend, and then pay taxes. There's a ton more that I won't go into right now, but if you don't at least have a side hustle, I think you're wasting a tremendous opportunity. Improving your health. Avoiding healthcare costs has one of the highest ROIs out of all investments discussed so far in this video. In fact, a study by the American Journal of Public Health in 2019 ranked medical expenses as the #1 cause of bankruptcy, stating, "Diseases or injuries can easily result in hundreds of thousands of dollars in medical bills. Bills that can quickly wipe out savings in retirement accounts, college education funds, and home equity." Another study estimated the per capita lifetime expenditures on healthcare to be $316,000, with the following distribution across age. This means you are currently expected to spend $153,000 after you reach age 65. Assuming you're 35 right now, and with an average annual inflation rate of 3.5%, you are expected to spend $417,000 on healthcare expenses after you hit 65. That's insane, and one massive financial reason to be as healthy as you reasonably can. The fourth bonus investment is saving time. We can all agree that other than health, our biggest asset is time. Save time by putting systems and processes in place, focusing on what matters most to you and what you can control, and invest in your health to maximize the amount of time that you have on this earth. The fifth and final bonus investment is building your personal infrastructure. In my opinion, being prepared for unexpected events should be standard for every adult, especially if you have kids. We are in a time where the prospects for serious food and energy shortages are a real threat. Get what you need now for food, water, energy, and medication while you can. Like all the other alternative investments, we'll do a deep dive into the 5 bonus investments as we go. As always, remember, wealth is not only about money and things. Your time and health is just as important, and working to improve all 3 pillars of wealth is key to thriving in life.